Welcome to the deep dive. Today, we're jumping straight into the heart of the matter. The analyst Q&A from JPMorgan Chase's Q3 2025 earnings call.
Yep, no prepared remarks today. We're focusing purely on the back and forth.
Exactly, because that's where you really hear the tough questions, where management gets pressed on, their assumptions, the risks they see.
And how those big picture things like interest rate moves or what's happening in the job market actually connect back to what the bank is doing day to day with its capital and lending strategy.
Right. It's about getting beyond the headline numbers. Are we just seeing things get back to normal after years of weirdness, or is something actually, deteriorating? Okay, let's unpack this Q&A. Where should we start? Maybe the big forward-looking number.
Yeah, let's start with NII, net interest income. They gave a central case forecast for 2026, specifically for what they call their NIX markets, so excluding the markets and investment banking side.
Okay, and what's that number?
They're targeting around $95 billion. That's the kind of core earnings power they're aiming for.
95 billion. Okay, but getting there seems to have hit a snag, right? Especially on the retail deposit side. I remember from their investor day, they were pretty optimistic, like 3% growth in Q4 25, then speeding up to 6% next year.
That was the plan.
Yeah.
But this quarter, deposit growth was basically flat, zero.
Oof. So what happened? What did management say?
Well, they pointed to a few big macro shifts. First, people just aren't saving as much. The personal savings rate is lower, but consumer spending is still really strong. So cash is going out the door.
Okay, that makes sense. People are spending. What else?
Second, the stock market's been on a tear, right?
Yeah.
So a lot of money that might have sat in checking accounts is flowing into investments instead.
So their wealth management arm is probably doing great, capturing those flows.
Exactly. Good for the overall firm, maybe.
But it's a headwind for the regular consumer bank deposits because people are actively chasing yield or, buying stocks with that cash.
Precisely. And the third point ties into that. Rates are just higher than the forwards expected. So customers are being smarter, optimizing where they keep their money. You can't blame them.
No, definitely not. But here's the interesting counterpoint. Despite balances being flat, they're still pulling in new customers, right?
Yeah, that was a key positive they highlighted. Over 400,000 net new checking accounts just this quarter.
Wow. So the franchise itself is still attracting people, even if the money immediately gets swept somewhere else for higher yield?
Right. It's just the brand is strong. People want to be with JPM long term. And, looking at their overall 2026 plan, they're still basing it on current forward curves.
Which means what for rate cuts?
It assumes 75 basis points of cuts in 2025, so 3/4 point cuts, and then another 2/4 point cuts in the first half of 2026. That path for rates is baked into that $95 billion NII target.
Got it. Okay, let's switch gears a bit, though it's definitely connected. Credit risk, specifically on the wholesale side. I mean, post-GFC, wholesale charge-offs have been almost ridiculously low, near zero sometimes.
It's been a very unusual environment.
So are analysts asking if we're just getting back to normal or if there's actual trouble brewing?
It seems more like normalization, but normalization driven by a change in what they're lending against. Management basically said, look, the expected charge-off rate for the loans we're making now is just going to be higher than the average of the last decade or so.
Even if the economy stays okay?
Even if the economy stays okay, it's about the mix of loans.
And that point was probably hammered home by some specific losses this quarter, wasn't it? They talked about First Brands and Tricolor.
Right. They were quick to say they have zero exposure to the First Brands situation, which got a lot of press.
Okay, good clarification.
But the Tricolor issue did hit them. That added $170 million in wholesale charge-offs this quarter.
170 million? Ouch, what was that?
They attributed it to apparent fraud in a secured lending deal.
Here.
So not a slow bleed, but a kind of sudden hit.
And that really highlights the risk in this changing portfolio mix you mentioned. They're doing more direct lending deals now.
Exactly. That was a big part of the discussion. They're stepping into more direct lending, and those deals inherently come with, let's say, slightly higher expected loss rates from the get-go. They're underwriting to a different standard for potentially better returns.
So higher expected charge-offs are sort of baked in now because they're chasing higher returns in slightly riskier areas.
That's the trade-off, yeah. Better revenues, potentially higher returns, but the baseline loss rate moves up. But, and this is important, they stress these new deals come with quite significant day-one reserve balances.
Meaning they're putting aside money for potential losses immediately.
Right. Their reserving methodology is apparently very granular and adjusts quickly when the loan mix changes like this. They're trying to get ahead of it.
Okay, and what's driving the demand for these kinds of deals? Is the market just more active?
Seems like it. They talked about animal spirits returning, healthy deal flow, especially in acquisition finance.
Yeah.
Big deals are back on the table.
Right, M&A picking up, which leads us nicely into capital.
Sure.
They're sitting on a ton of excess capital. What's the plan there? Just keep piling it up.
No, the goal now is actually to stop growing that excess capital pile. They want to put it to work by growing their risk-weighted assets, their RWA. Use the balance sheet, basically.
And they announced a pretty massive way they plan to do that, didn't they?
Huge. A commitment to lend an extra $500 billion, $500 billion over the next 10 years.
$500 billion, wow.
To which areas?
To industries they see as critical for U.S. security. Plus, another $10 billion in direct equity investments alongside that.
So what does that signal? I mean, $500 billion is a lot.
Yeah.
Does it mean they feel pretty comfortable about their capital levels and the regulatory outlook?
It definitely signals confidence. They framed it as an all-of-the-above approach. They think they can make this massive lending commitment and still do significant buybacks and keep paying dividends. It says their capital generation is strong enough to do it all. Okay, but growth like that costs money. Which brings us to expenses. And inevitably, AI. Management seemed to think the analyst consensus for 2026 expenses around $100 billion was maybe a bit optimistic.
Yeah, they said it looked a little bit low. The cost pressures are real. They're budgeting for labor inflation, kind of settling into a new normal of, say, 3% to 4% a year.
Okay.
And they called out one specific big jump: medical expenses. They spend about $3 billion a year on that now, and they expect it to be up 10% next year.
10%, that's a serious headwind. So how does AI fit into managing this? They talked about it being a tailwind.
Right. Their angle wasn't AI is going to slash X number of jobs. It was more subtle. They're saying AI productivity enables them to maintain old-fashioned expense discipline. It helps them constrain overall headcount growth, even with those wage and benefit pressures.
So it's not AI directly cutting costs, but AI making it possible to hold the line elsewhere. Like without AI, headcount would have had to grow even more to support the business.
That seems to be the argument. It's an enabler for discipline. Rather than them trying to point to Project X saved Y dollars, it helps them avoid even higher expense growth.
Okay, a practical take. Maybe not the revolutionary cost cutting some people expect from AI. Now, let's shift to a section that sounded pretty tense in the Q&A. Risk in non-bank financial institutions, NDFIs, especially after that tricolor loss.
Yeah, NDFIs. This is a huge, messy category, isn't it? It's everything from private equity, private credit funds, BDCs, hedge funds, even some fintech lenders. Basically, financial players operating outside the traditional, highly regulated banking system.
And JPM was careful to point out their own exposure, right?
Very careful. They stress that the vast majority of their lending to NDFIs is highly secured, structured, or securitized. It's not like they're just writing massive unsecured checks to risky funds.
Okay, that's important context for their book. But the CEO also gave a broader warning about the sector, didn't he? Something about double leverage.
Yeah, that was sobering. He acknowledged that while many NDFIs are sophisticated, there's a part of that world where you have leverage on top of leverage. You're lending to an entity that is itself already leveraged up. That multiplies risk fast if things go south.
So the big question is, if there's a downturn, what happens with lending standards you can't really see in these less regulated NDFIs?
Well, the expectation, as management put it, is that credit losses in that NDFI space could be a little bit worse than other people expected, simply because the underwriting, the risk models, it's more opaque. It hasn't been stress tested in the same way as bank lending.
And after the tricolor fraud, the CEO used that pretty stark analogy.
The one cockroach analogy. Yeah. When you see one cockroach, there are probably more.
You don't hear CEOs talk like that often. It really suggests they're turning over every rock internally now, right? Scouring processes.
Absolutely. That sends a powerful message. And the advice for you, the listener or investor, is pretty clear. Dig into the disclosures of things like BDCs, the publicly traded private credit firms. That's where you get some visibility into this space.
Okay, good practical advice. Let's touch on the broader regulatory picture. Always a moving target. The current administration has a bias for action, as they put it. Did JPM sound happy with the direction things are going?
Reasonably encouraged, I'd say. They seem to like the focus on looking at capital rules holistically and, importantly, on doing the math right. for specific risks like mortgages. They prefer that granular approach rather than just setting some big overall capital target that might not accurately reflect the underlying risks.
But they still have frustrations.
Oh, definitely. They still think rules around the GSIB surcharge, CCR stress tests, operational risk capital, they feel some of those calculations are inaccurate and don't reflect their true risk profile. And they repeated the argument that overly strict rules inside banks just push risk outside the system.
Into those NDFIs we were just talking about.
Exactly. It's that constant tension. On housing, they had specific ideas too, to get mortgage rates down closer to Treasury yields.
Yeah, what was their take there?
Focus on supply-side issues, make it easier to build, faster permitting, that kind of thing, and also reduce the costs baked into securitization, origination, and servicing. They think that could shave 30 to 40 basis points off mortgage costs for consumers.
Interesting. Specific policy levers there. And quickly, investment banking. Still looking busy.
Pipeline sounds robust. M&A is a big driver, plus IPOs that were kind of waiting in the wings are starting to launch.
So the REIT environment is basically okay for deals.
Seems good enough, was the message. Sophisticated sponsors aren't waiting for perfect conditions. If the deal makes sense, they're doing it.
All right, let's wrap up with a couple of consumer details. The Sapphire credit card refresh had some weird accounting impact.
Yeah, short-term quirk. Basically, the revenue rate looked temporarily negative on the NII line.
Negative. How does that happen?
Because customers started getting the increased value, the better rewards before the higher annual fee kicked in. The cost of those extra rewards hits the P&L immediately as negative NII, but the extra fee income only flows in later. It should normalize over a few quarters.
Okay. So an accounting timing thing, not a fundamental problem. And last point, deposit market share. They admitted losing a little ground recently.
Yeah, which ties back to our earlier discussion about people chasing yield.
Mm-hmm.
But they framed it as a conscious choice. They're being disciplined on pricing. They aren't going to pay top dollar just to keep every single deposit.
They're playing the long game.
That's the strategy. They still aim for 15% retail deposit share long term, but through investing in the branches, better products, deepening relationships, not just by offering the highest rate on the street.
Okay, wow. We covered a lot there.
Yeah.
From that big $95 billion NII target and the flat deposits, through the wholesale credit shifts and the tricolor hit, the huge $500 billion deployment, expense pressures, NDFI risks.
I think the underlying theme was, confidence in their own engine, the consumer, the capital generation, but definitely a wary eye on those external risks, especially the ones lurking in the less regulated parts of the financial system.
Right. So what's the key takeaway for you listening to all this?
Well, here's something to think about. The bank openly acknowledges they're moving into slightly riskier direct lending for better returns. They also openly worry about the unknown standards in the NDFI world outside the banking perimeter. So the provocative thought is, how do you, as an investor or just an observer, weigh those potentially higher returns against the risk that the next downturn exposes serious credit problems hiding in plain sight just outside the reach of the regulators? Something to definitely mull over.